I'm going to explain the differences between margin and futures trading. Now to do this, I'll be using Bitget to help. Although I'll be using Bitget to explain the differences, the same ideas can be applied to any exchange. As you can see, I've created this table here to help. Now before I go through the differences, I first want to say that if you don't already have an account with Bitget by chance and are interested in using them, I'll leave a sign up link in the video description where you can save 20% on your trade fees. So for both margin and futures trading, they are both similar in that you would be borrowing against your coins to put on a leveraged trade. This means that both your gains and losses are magnified. As you're borrowing against your coins, this means that you can get liquidated. Liquidation happens when the value of the amount that you borrowed is worth roughly your collateral amount. As a result of that, your own coins are automatically taken and you're left with nothing in your account. So pretty much just those two things are the same. Let's now take a look at the differences. So the first difference is the market that they're traded on. Margin trading uses the spot market while futures trading has its own market. So if I go to Bitget, you can see that if I hover over trade, there's spot and futures. They're both different markets, each with their own order book, liquidity, and chart. As for the base trade fees, they also differ. For spot trading, the fee is 0.1% for both makers and takers, while futures trading is 0.02% for makers and 0.06% for takers. Now, when it comes to borrow fees, they both have their own fee structure. For margin, you pay interest on the coins that you borrow. The interest rate can change at any time, accrues hourly, and can be paid back at any time. To find out the interest rate of the coin that you're borrowing on the spot market on Bitget, you can go to this page over here. Here, you can find their daily and their annual rate to borrow for whichever coin. To get the hourly rate, you would just take their daily rate and divide it by 24. As for futures trading, depending on your position that you've taken, you may have to pay interest or you get paid interest. This all depends on the funding rate for the coin, which can change at any time. The funding rate can either be positive or negative. When the funding rate is positive, this means that people going long pay shorts. If the funding rate is negative, this means that shorts pay longs at settlement. Settlement of funding is every 8 hours. If we take a look at the futures market for Bitcoin, we can see that the funding rate right now is positive. This means that the longs will need to pay the shorts on their whole outstanding position, not just the amount that was borrowed or leveraged at the end of the countdown. The 8-hour period is just when settlement of funding is paid or paid out. As for the process to put on a margin trade, you would first need to select and fund either your cross or isolated account. After, you would borrow the coin that you're looking to long or short. If you're looking to long, you would borrow USDT. If you're looking to short, you would borrow the coin that you would want to short. You would then open your position by either buying or selling the coin depending on your position. To close out your position, you would have to do the opposite by selling if you went long or buying back if you went short. If you went long, you would need to ensure that you have enough USDT to repay your loan plus any interest. If you won on your trade, then there's no issue. However, if you lost on your trade, you would need to fork out your own USDT to pay for the difference and any interest. If you went short, you would need to make sure that you repurchase enough of the coin to cover your outstanding interest on that coin. If it was a winning trade, then there's no issue. However, if it was a losing trade, you would need to fork out your own USDT to buy more of that coin to pay for the difference along with any interest. So back on Bitget, if you go to the spot market and click on either cross or isolated, you can see that there's an option to automatically borrow and repay the coins. This makes the process much more seamless and less tedious. There's also an option to manually borrow and repay the coins if you wanted to do that as well. Now, as for futures, to enter a position, the process is much simpler. All you would need to do is select your leverage amount and then click a button to open it. To close it out, you would just do the same thing and click a button. So back on Bitget's futures market, we can see that over here, there are a couple of buttons. One is to open the position along with one to close it out. On the bottom, you have buy and also a sell button. So the last difference between margin and futures is the leverage amount. With margin, the maximum that you can leverage is 10x. This depends on two factors. First is how you choose to collateralize your debt, and the second is the coin. As for futures, the maximum that you can leverage is 125x, but this depends primarily on the coin. Each coin will have their max leverage amount. How you choose to collateralize your debt won't affect the leverage max amount. So if we go back to Bitget's spot market, we can see that for Bitcoin, the maximum amount that you can leverage is 10x. That's if you select isolated. If you select cross, however, then it's only 3x. Now, if you take a look at Shiba, you can see that for cross, it's maximum 3x, and for isolated, it's only 5x. As for futures, you can see that for Bitcoin, the maximum leverage is 125x. However, for other coins like TRX, the maximum leverage is 30x. So there you have it. Those are the main differences between margin and futures trading on Bitget. The idea is the same thing on any other exchange, but I just use Bitget as an example. Hope you learned something, and thanks for watching.